Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video, I did my first option trade for this year, 2019. Today is February the 5th, 2019, and I did this just yesterday. I bought a call option on Microsoft. Here's my call right here. It is a $105 call. Expires in January of 2021. That is 2 years from now. And I spent $1,600 for that. And then I sold to open a weekly call. Here it is right here. It is a $106 call option and it expires Friday. And I got $84 for it. Let's go to the transactions here. And so here's the long call that I bought. Cost me $1,600. And here is the short call that I sold to open. I got 83, and so $82.23. I got a bunch of free trades from Ameritrade. I've been sitting on the sidelines the whole month of January waiting for my account to get all straightened out. It's finally straightened out, and so I'm back in the game. Now I picked Microsoft for the simple reason that I don't know what the market is going to do this year. I don't know if we're going to hit a recession, if we're going to hit lots of turbulence. I believe we are. So I wanted to pick a stock a company that I feel has very stable company, a stable stock. And let's go to Microsoft. This is a Microsoft 5-year chart. So it does almost exactly what the market does. If we look at the SPY, this is the SPY. It looks almost identical. But if we go back to Microsoft here, the Microsoft curve, come on. Oh, I did a typo. Apologize for that. Let me put that in right. All right. If we look at this curve, you can see it's even more smooth. I like nice smooth curve, and all of this headwind up there, that's all of the crazy volatility that the market's been doing like these last few months. So that's why I picked Microsoft. Microsoft did not have a very good earnings, but I'm not really worried about that so much. It still has a very strong chart, and I feel very comfortable. Now, I am going to get back into Twitter, but Twitter has an earnings coming up this Thursday. I'm going to wait until after Thursday to get back in Twitter, but for now, I am in Microsoft, and this is my first trade of the year. Now, again, I like doing diagonal spreads, okay? Diagonal, and the spreads that I like doing is I like buying a call, a LEAP, leverage equity anticipated price. That's what LEAP stands for. And so this long call here, 105, is 2 years expiration, and then I like to sell weeklies, okay? Because I have a $105 call. I spent $1,600 for it, okay? Now, if let's say Microsoft stays flat. Let's say it stays right around the range where it's at. And just for information here, Microsoft closed at $105.61. Actually, this is a pre-market. I'm sorry. Microsoft closed at 105.74. So if Microsoft stayed flat and I were just to sell weekly calls and I make, let's say, $80 a week, then there's 52 weeks in a year. So let's say I only make $60 a week. That's $3,000 on a $1,600 investment, which would come to a $1,400 profit. Okay, so that's why I like these diagonal spreads. And let me show you the option chain here on Microsoft. Okay, so if we look at these, they excuse me, they all go for about 84, and these are very near the money strike prices. Okay, now let's say we go out a month. Okay, let's go to 31 days. Now that's showing a strike price of 200, and let's even go to the ask. Let's say we get $240 for this. Okay, so if we do a little bit of math, okay, and we were to collect $84, or even if it's just $80, even if we just collected $80, not even up at the ask, okay? If we made $80 a week, and let's say there's 4 weeks in a month, right? That's 28 days. There's actually a few more days. And then 80 times 4 is $320. But if I sell a monthly call, I don't make $320. I only make this $240, right? So you can see the numbers favor the money that you make when you sell to open weekly calls, or if you're buying puts, same thing. You would buy a long-term put and sell a weekly put. This is the way that I like to trade my options. I like to buy long-term calls or long-term puts, and whenever you buy a call or a put, you're making a bet. If you buy a call, you're betting the stock's going to go up. If you're buying a put, you're betting the stock's going to go down. So I'm entering back into the game very slowly. I only have one contract, right? And the cool thing about buying call options is that a call option is a contract to buy Microsoft at $105 a share. Now, if I wanted to, I could just buy 100 shares, right? But it would cost me $10,500, right? This call option, $105, gives me the right to buy 100 shares of Microsoft at $105 a share anytime between now and January 15, 2021. Now, if I wanted to, I could have bought 100 shares, not even messing around with the options, but I would have had to spend $10,500. So just the very fact that I'm buying calls instead of buying shares already, I am using a wonderful risk management, some good risk management. Instead of risking $10,500 on my money, I'm only risking $1,600. Okay. Then I do some more risk management. You add risk management onto risk management by selling to open calls, right? Now, instead of risking $1,600, I get to subtract this $80 that I'm going to make between now and Friday. Now, if Microsoft does go above $106, I've talked about this before, I use a rolling up strategy where I would buy to close this for whatever price it's going for. So let's say that I were to do that right now. Let's say that I bought this call a few days ago. Let's say I bought it sometime last week, and let's say Microsoft was down and I had to buy to close, let's say 103. So I would spend, let's say $310. We'll go with the ask, okay? And then I would want to sell to open another call higher than 103, so like 104 or 105, and try to get more than 310. So if I went out 10 days, 104, it's only 270, so I'd have to go out further. So let's say I go out a month. Actually, let's go out to the 15th. That's a monthly, okay? Look at that, okay? A 105, 320. The bid is 315. The ask is 325. So I would buy to close this for the 310, which is a 103, and then I get to sell to open a 105 at 320. Thereby, I increase my intrinsic value of my call by $2, and I buy this back for 310, and I sell to open this for 320. So that's the rolling out strategy. That's how to roll up. And that's why there is no risk on the upside when you do diagonal spreads like this. The only real risk is if for some screwball reason Microsoft were to go down to like $90 or $95, then I would have a problem. But notice that I have all this money on the sidelines. Let me go to my balances here. So these are my balances. I'm only risking, this is the money that I have left down here. That's what I've got invested in all of this right here, cash available for withdrawal. I have all that money left over that I can buy more calls, or I can sell lower strike prices, and I can do credit call spreads where I can sell maybe $100 strikes or 95, whatever I feel is a safe price. And then if Microsoft decides to rebound, then I go back to just rolling up. So it's a super safe strategy. And Microsoft is not exactly a stock that's going to go down to like $50. I mean, I would hate to see that, but if that happens, then I just lose $1,600, which is still better than if I owned 100 shares. I had $10,500 that I paid for the 100 shares. And now, if Microsoft went down to $50 a share, I'd only have $5,000. I'd lose $5,000 versus losing the $1,600 I spent. So either way, I am better off buying call options, and I am always going to encourage everybody, get into this. Start buying and selling calls and puts. This is a way better way to make money than buying stock. So that's it for this video. Thank you for watching, and finally there will be some more videos to come. I plan to slowly move back into the game. I've got lots of other stock ideas. I'm thinking maybe Apple. I'm thinking maybe GLD. I am going to get back into Twitter. After Twitter announces its earnings on Thursday, I'm going to wait till after its move, it establishes its range, and then its new range, and then I'm going to buy a call or a put, and I'm going to do the same thing. I love these diagonal spreads. I think it's my favorite strategy so far, and we'll see where it goes. I'm always trying to improve my performance, and who knows, maybe I'll get back into the SPY someday. I tried that once, and it's a high roller stock. It's a big boy stock. I'm a little boy, and I like nice, calm, smooth stocks. I mean, Twitter is right at the edge of my comfort zone, but I enjoy Twitter because it's only a $30 stock. So thank you for watching this video, and have a great day, and I will see you in the next video.